Silver just crossed $100 an ounce. Not someday, not theoretically, right now. It doubled in a year. Headlines are screaming bull market. Retail is piling in. Institutions are adding positions. Everyone sees the same chart going vertical. But here's what they're not seeing. Physical supply is tightening while paper claims are exploding. Dealer premiums refuse to fall despite price ripping higher. Warehouse stocks are quietly draining. Delivery delays are stretching from days into weeks. Lease rates just spiked harder than they have in years. If you're holding silver, watching this market, or trying to understand what's actually happening beneath the price action, you need to understand this. What looks like a rally on the surface is actually a stress test underneath. The crowd will figure this out after volatility hits. You're here now. That puts you ahead. Your job isn't to predict where price goes next. Your job is to recognize the pattern before the system dislocates. This video will show you how. Before we go further, hit subscribe if you're not already with us. We don't chase headlines here. We study structure. We track ignored signals. We build a community that sees patterns early and compares notes without the hype. Comment, watching. If you're here before, this becomes mainstream conversation. Here's what happened. Silver moved from the mid-80s to over 100 in a matter of weeks. That's roughly 20% in an already accelerated market. Volume surged. Retail dealers got slammed with orders. Industrial buyers locked contracts early. ETF inflows accelerated, while COMEX registered inventory dropped steadily. Why does this matter? Not because round numbers are magic. Because price acceleration during constrained supply historically leads to instability. The public narrative is excitement. Bull market energy. Finally breaking out. But underneath, physical markets are showing strain. Premiums aren't compressing like they should when price rallies. Lease rates spiked overnight. Delivery times extended without explanation. If price is the headline, premiums are the confession. Most people only see one layer. We're going to look at three: the visible rally, the hidden stress, and the repeating mechanisms that show up every single time a market moves from tight to squeeze. Let's start with what's actually happening. Here's the first mechanism you need to understand. Paper versus physical squeeze. Think about it like this. Imagine a stadium that sold 10 tickets for every actual seat. Works perfectly fine as long as most people never show up. The system runs smooth, prices stay stable. Nobody notices the mismatch. But the moment people start demanding their seats, the whole thing breaks. That's silver right now. Most of the silver market trades as claims, futures contracts, ETF shares, allocated accounts, unallocated accounts, digital entries on balance sheets. The vast majority of transactions never touch physical metal. They settle in cash or roll forward or net out between parties. For years, that worked. But when demand shifts from paper exposure to physical delivery, stress appears fast. We've seen this pattern repeat across markets. Oil in contango squeezes, nickel on the LME in 2022, lumber during supply shocks, palladium in the early 2000s. Even bank runs follow the same logic. The claims exceed the underlying asset. And when enough people show up, the system can't deliver. Silver isn't unique. The mechanism is universal. Right now, we're watching premiums that should compress during a price rally instead hold firm or widen. That tells you demand isn't satisfied by higher prices. It's chasing availability. Dealers are paying more over spot to secure inventory. Mints are extending lead times. Wholesalers are limiting order sizes. Circle this. When claims explode faster than available metal, the spread between paper and physical becomes the signal everyone ignores until it's too late. The most dangerous rallies aren't the loud ones. They're the ones where liquidity disappears silently. You won't see it on a price chart. You see it in delivery times, in premiums, in lease rates, in the quiet phone calls between dealers scrambling to source product. This isn't about predicting the top or calling a crash, not telling you to buy or sell. This is pattern recognition. You're learning to see structural stress before the majority even knows to look. History shows that when paper and physical decouple, one of three things happens fast. Premiums spike violently and price follows. Exchanges change margin requirements or delivery terms to reduce stress, or policy intervenes with export restrictions, position limits, or force liquidations. We can't know which path or when. But we can watch the signals that show stress is building. That's the edge, not prediction. Recognition. And here's the thing most people miss. The squeeze doesn't need a conspiracy. It doesn't need manipulation or a grand plan. It just needs math. More claims than metal, more demand than supply, more delivery requests than inventory. The system built the mismatch itself. Now let's talk about what happens when high prices don't fix the problem. Second mechanism, rationing spiral. In a healthy market, higher prices destroy demand. Price goes up, buyers back off. Supply catches up, balance restores. Clean, predictable. Economics 101. But in a shortage market, that logic breaks. Higher prices don't cool demand. They expose how inelastic demand really is. Industrial users can't easily substitute silver out of solar panels, electronics, or medical applications. Mints keep ordering blanks because demand for coins is surging. Investors chase scarcity because they see tightness as confirmation. Institutions add positions because momentum models trigger. So price rises, and instead of killing demand, it pulls forward more demand. Think about that. What happens when high prices don't ration buyers? The market starts rationing by availability instead of price. Delivery delays replace price signals. Limits on order size replace open access. Premiums widen because allocation becomes the real currency. We saw this in semiconductors, in shipping containers, in natural gas during European energy crunch, in every market where supply can't respond fast enough to match demand surges. Shortages don't announce themselves. They ration silently. You don't wake up to a headline that says, "Silver shortage declared." You wake up to your dealer saying 4-week delays instead of 2-day shipping. You see premiums hold at 8% when they should drop to 3%. You watch lease rates spike because someone, somewhere, desperately needs to borrow metal they can't source outright. Here's where it compounds. When rationing starts, behavior changes. Buyers who were patient start front-running. Orders get doubled as hedges. Inventory gets hoarded. The scramble for supply accelerates the very tightness everyone's reacting to. That's the spiral. It's not linear, it's reflexive. And once it starts, it doesn't calm down just because price went up. It calms down when supply finally catches up, or demand gets forcibly destroyed through volatility, policy, or exhaustion. Now, imagine you're a participant in this market without understanding the mechanism. You see price ripping higher, you feel FOMO, you chase, you leverage up. Then price pulls back hard because a big holder liquidates or a policy headline hits or margin requirements change. You panic. You sell at the bottom. Price rips again. You're whipsawed. Volatility is the tax paid by people who don't understand the mechanism. We're not saying silver is in a full rationing spiral right now. We're saying the early signs are visible, premiums sticky, inventories draining, lease rates elevated, delivery times extending, could reverse tomorrow, could normalize next month. We can't know timing. We can only track structure. But if you understand the pattern, you recognize the signals. You adjust risk accordingly. You don't get emotionally yanked around by price swings because you're watching the underlying mechanics, not just the chart. That's the difference between informed participation and reactive gambling. You're learning to see what most people miss. Now, here's the question nobody's asking. Everyone's asking, will silver go higher? Wrong question. The real question is this. How would you know if the system is under strain before everyone else does? How do you spot the early warnings of a paper-physical disconnect or a rationing spiral before they become obvious? Most people only notice shortages after shelves are empty. By then, premiums have exploded, liquidity has vanished, and volatility has shaken out everyone who wasn't prepared. You don't want to be late to that realization. Here's what you need to sit with. The signals that matter most are the ones that don't make headlines. They're quiet, they're technical, they show up in data most participants ignore. Premiums, lease rates, inventory flows, delivery times, price behavior on pullbacks. If you're tracking those, you see stress building in real time. If you're not, you're flying blind. The next section is going to give you a practical framework, specific signals you can watch this week, what normal looks like versus what stress looks like, and how to interpret the data without needing a PhD or insider access. Let's get into it. We don't predict. We map paths. Here are 3 scenarios based on structure, not opinion. Path 1. Cooling rally. Price consolidates or pulls back. Premiums compress toward historical norms. Inventories stabilize or rebuild slightly. Lease rates drop back near zero. Delivery times return to normal. This happens if demand moderates, supply catches up, or speculative positioning unwinds without forced liquidation. Who struggles here? Over-leveraged longs expecting vertical moves, late chasers who bought tops, emotional holders who panic sold dips. Who does fine? Anyone managing position size, anyone watching signals instead of headlines, anyone comfortable holding through noise. Path 2. Grinding squeeze. Price consolidates at elevated levels but doesn't break down. Premiums stay wide. Inventories continue slow, steady drawdowns. Lease rates stay elevated with occasional spikes. Delivery delays persist. This happens when demand stays strong but doesn't accelerate into panic. Industrial users keep buying. Retail keeps stacking. Institutions stay positioned. Supply struggles to catch up but doesn't collapse. Who struggles here? Traders expecting quick resolution. Anyone using tight stops in a choppy range. Anyone emotionally exhausted by volatility. Who does fine? Patient participants. Anyone respecting the grind. Anyone tracking incremental changes in supply signals. Path 3. Disorderly move. Price goes parabolic or crashes violently. Premiums spike to double digits or collapse. Inventories fall sharply or policy steps in. Lease rates explode. Delivery becomes impossible or unrestricted. This happens when feedback loops break containment. A major holder liquidates. An exchange changes rules mid-game. A government restricts exports. A default happens somewhere in the chain. Who struggles here? Almost everyone unprepared for speed. Leverage participants on either side. Emotional decision makers. Who does fine? Those with dry powder and no leverage. Those who planned for volatility. Those who understand the game can change mid-play. We can't know which path. We can only watch which signals are firing. What I'm tracking this week. Not advice. Framework. These are the signals I watch to understand where we are in the structure. Signal 1. Dealer premiums. Over spot. Normal market. Premiums compress when price rallies. Higher price satisfies demand, spread tightens. Stress market. Premiums hold firm or widen despite price increases. Indicates demand chasing availability, not just exposure. What I'm watching are premiums for physical rounds, bars, and coins staying elevated. Are they widening on pullbacks? Signal 2. COMEX and LBMA registered inventory. Normal market. Inventories fluctuate but stay generally stable. Inflows match outflows. Stress market. Steady drawdowns week after week. Registered stocks falling while open interest stays high or grows. What I'm watching? Weekly inventory reports. Are registered ounces declining consistently? Is the ratio of paper claims to deliverable metal rising? Signal 3. Silver lease rates. Normal market. Lease rates near zero or slightly negative. Indicates ample supply for borrowing. Stress market. Lease rates spike positive, sometimes sharply. Indicates tight physical availability and urgent demand to borrow. What I'm watching? Are lease rates elevated? Are they spiking intermittently? That's a red flag for supply stress. Signal 4. Delivery times from major dealers. Normal market. Orders ship in days. Inventory turns fast. Stress market. Delays extend to weeks. Backlogs grow. Dealers limit order sizes. What I'm watching? Are lead times stretching? Are dealers communicating supply constraints? Signal 5. Price behavior on pullbacks. Normal market. Pullbacks see weak bounces. Buyers wait for confirmation. Stress market. Dips get bought aggressively. Price snaps back fast. Indicates strong underlying demand. What I'm watching? How does price react when it drops 3 to 5%? Does it grind lower or rip back immediately? Risk cluster. How I approach. This not commands. Just how I think about positioning in uncertain, volatile environments. Avoid leverage I don't fully understand. Leverage amplifies mistakes in fast markets. Respect liquidity. If I can't exit a position quickly, I size it smaller. Diversify information sources. I don't rely on one data point or one voice. Track signals weekly. I review premiums, inventories, lease rates, and delivery times every week, not just when price moves. Journal observations. I write down what I see so I can compare over time. Patterns emerge in the data, not the emotion. Accept that volatility is the cost of participation. If I can't handle sharp moves, I shouldn't be in the market, or I need to size way down. Know what I own and why. If I'm holding physical, I accept illiquidity and premiums. If I'm trading paper, I accept counterparty risk and sudden rule changes. Your job isn't to be right about the future. Your job is to stay positioned so that being wrong doesn't wreck you. That's risk management in a market showing early stress signals. Not guarantees, not predictions, just frameworks for interpreting what we're seeing in real time. Here's where you are right now. You understand two mechanisms that repeat across every commodity squeeze, every liquidity event, every shortage market. Paper versus physical squeeze. Rationing spiral. You have a watch list of 5 signals you can track this week. Premiums, inventories, lease rates, delivery times, price behavior. You know what normal looks like versus stress. Most participants don't have that. They're reacting to headlines, chasing price, getting whipsawed by volatility they don't understand. You're in the group that tracks structure, that watches ignored signals, that recognizes patterns early. If you stay disciplined, manage risk, and keep watching the signals instead of getting hypnotized by price, you put yourself in the minority that doesn't get shaken out when volatility spikes. Do you track premiums or just price? Drop a comment. I want to know what you're seeing in real time. Which signal are you watching shift right now? Inventories, lease rates, delivery delays? Let's compare notes. If this helped you see the market differently, hit subscribe. We do this every week. No hype, no predictions, just pattern recognition and signal tracking. Share this with someone who's watching silver right now and trying to make sense of the move. They need this framework. Final thought? Price tells you what happened. Structure tells you what's coming. Scarcity doesn't shout. It leaks. Volatility punishes ignorance, not participation. Stay sharp. Track the signals. And I'll see you in the next one.